I've been adding more shares of Roundhill's WeeklyPay Universe ETF, also known as WPAY. Ever since the hype around certain weekly pay funds started to fade, this ETF has stepped in as a much stronger, more balanced option. And what makes it stand out is that it's basically a fund of funds built from Roundhill's entire weekly pay lineup. But the real reason I like WPAY isn't just the income. This thing actually has room for growth too. When it launched, the price climbed nicely before the recent pullback across the whole market. So while the chart doesn't look great in the short term, the bigger picture shows that if the underlying stocks recover, it can bounce back as well. I personally added more shares when the price dipped, mainly because I wanted to lower my average cost and take advantage of the current market weakness. Everything has been pulling back lately, and I've been sitting on extra cash waiting for opportunities like this. Now, even though the share price is down from where it started, the weekly distributions I've received have helped offset a lot of that. I've been holding WPAY since it launched, and getting paid every single week adds up fast. That's why the short-term drop doesn't bother me too much. Market dips are normal, especially for an ETF like this. It uses leverage, so when the market has a rough month, this fund feels it even more. That's part of the deal. But the way I see it, that volatility also creates buying opportunities. When you look under the hood, WPAY currently holds a bunch of Roundhill's single stock weekly pay ETF. And even though it's a fund of funds, the exposure is surprisingly clean. It's mostly focused on big, well-known companies, the type of stocks everyone recognizes. You're not getting a bunch of meme names, and you're not taking on weird speculative bets that crash the second the market gets shaky. It's tilted heavily toward tech, which explains some of the recent volatility, but last week Roundhill added more companies to the WPAY lineup. These include Uber, Arm, Alibaba, and Costco. Slowly, it is becoming a more diversified blend of tech, retail, international commerce, and growth names. And it's now turning into a more mixed ecosystem. This broader mix means it no longer moves based on just a handful of mega-cap stocks. It reacts to trends across multiple industries. This suggests everything is equal-weighted and rebalanced regularly, so nothing gets too oversized and the risk stays spread out. What I also like about WPAY is that it lets you avoid the biggest problem with these weekly single-stock ETF. You don't have to pick one company and rely on it. I've said plenty of times that single-stock ETF are risky. If Apple or Tesla or Amazon has a bad month, you feel it instantly. WPAY mixes all of them together in one place and still gives you the weekly distributions people love. The distributions themselves have been pretty solid. They'll move around over time just like any income ETF, but for something built with leverage, it's been fairly consistent so far. And because this fund is passively managed at the top level, while the underlying ETF are actively managed, everything gets updated and rebalanced in the background. You just hold the fund, and you get the weekly payments. Another thing to keep in mind is the expense ratio. There's a waiver in place right now that keeps the cost lower than it normally would be. If that changes in the future, the fee will increase, but for now, it's still manageable, especially considering the structure of the fund. Now, if you're wondering whether WPAY has actually made money for investors, that depends on whether you reinvest the distributions or not. On paper, the share price alone is down from the launch. But once you factor in the weekly payouts, the total return looks noticeably better. That's the difference people sometimes forget. A weekly income fund isn't designed to moonshot in price. It's designed to generate regular cash flow. Roundhill has been expanding this entire weekly pay lineup fast. They now have weekly ETF for bonds, gold miners, and even treasury exposure. These aren't included in WPAY yet, so if you want exposure to those, you still have to buy them separately. But if you've been following the market, you'll notice these new funds have actually been gaining attention, especially in areas like gold and bonds where volatility is lower but income is still attractive. The Treasury Weekly Pay ETF in particular caught my eye because it gives weekly payouts on something that usually only pays monthly or quarterly. It's basically a twist on traditional bond investing, and I've been keeping an eye on it as a possible alternative to just holding long-term treasuries outright. Roundhill's Meiji ETF, their Magnificent 7 weekly pay fund, works in a completely different way compared to something like the treasury-based TSYW that we talked about earlier. TSYW is tied to long-term bonds, so it naturally moves slower and feels more stable. MAGY, on the other hand, uses covered calls on some of the biggest tech names on the planet. That keeps the swings softer than something like WPAY, but still gives you exposure to those massive companies. If you're someone who wants stability, TSYW or even MAGY might feel more comfortable. But if you're okay with a little extra movement because you want that potential upside during stronger weeks, WPAY usually ends up being the more explosive option. Anyway, coming back to WPAY, despite the recent dip, I still like the long-term setup. When the market eventually recovers, the underlying stocks in this fund should climb with it. And when they do, WPAY should reflect that. Meanwhile, you keep collecting weekly income the whole time. If the price falls even more, I'll probably buy additional shares just to keep lowering my average cost. For me, WPAY fits the style of investing I enjoy. Simple structure, recognizable holdings, weekly cash flow, and actual potential to grow when stocks rally. It's not risk-free and it's definitely not for everyone. But for my personal tolerance, it makes sense. Roundhill seems committed to expanding and improving their WeeklyPay ecosystem. That's important. When an ETF issuer actually invests time and resources into evolving their product lineup, it usually means they see strong demand and long-term potential. And honestly, they're filling a niche no one else has properly filled yet. Most weekly income products in the market rely on covered calls. Roundhill leaned into total return swaps instead, which lets WPAY capture more upside during bull markets while still generating consistent weekly income. It's a very different structure from most big-name income ETFs out there. And that uniqueness is exactly why WPAY stands out to me. As we wrap up, here's the big takeaway. WPAY continues to stand out because of its structure, its weekly approach, and its ability to move with, and sometimes ahead of, its underlying stocks. If you're someone who enjoys following active ETFs with unique strategies, WPAY is definitely one worth keeping on your radar. Let me know what you think about WPAY in the comments. If you found this breakdown helpful, make sure to subscribe to Money Stick Unfiltered, and I'll see you in the next video.